Are you struggling with the CPA exam because your course failed to fit your learning style? I'm Darius Clark of I-75 CPA Review, where the right teacher makes all the difference. I want you to imagine this scenario. You're taking the CPA REG exam. You just finished your last multiple choice question. You clicked on your first task-based simulation, and right in front of you stands a real estate closing statement. It's got columns for debits and credits, but it doesn't look like accounting. It contains separate sections for deposits, prorations, loans, title charges, government recording and transfer charges, and you're sitting there like, are you kidding me? I studied distributions and basis and like-kind exchanges. But real estate closing statements are a very big part of tax. What's the real story here? Well, closing statements can be on your REG exam. And like any other topic, you got to know something about it. When a real estate transaction happens and the property changes ownership from seller to buyer, that is referred to as a real estate closing. And there's usually a closing company that will get paid to facilitate the actual transfer of ownership from seller to buyer. The closing company will prepare and give both buyer and seller a copy of the closing or settlement statement, which shows the sale price and an all-important breakdown of the fees and expenses for both buyer and seller, as well as funds needed from the buyer to close the transaction and the exact amount of proceeds going to the seller. There is no one closing statement that every closing company uses, nor will all of these items in this particular closing statement be on the one that you'll see on the exam. So what I want to do is go over some of the more common items that you're likely to see on the exam, and at the same time talk about this debit and credit. And while debit will always mean left side and credit will always mean right side, there's nothing else really in common between debits and credits on a closing statement and debits and credits in accounting. On a closing statement, a credit is good for you. A debit is bad for you. So this is a buyer's side closing statement. What we're looking at right now has to do with the buyer. So the credit side are things that are going to help the buyer become the owner of the property. One of these things, the biggest one here, is the principal amount of the new loan, $272,000. This loan is going to help the buyer become the owner of the property, and that's why the loan is on the credit side for the buyer. On the debit side for the buyer are things that are going to cost the buyer money in order to become the owner, starting with the contract sales price. And then there's all these other charges here on the left side, and if we scroll down, we'd see even more charges that the buyer's going to have to come up with to become the owner. So the buyer's bringing to the closing a loan amount of $272,000 in order to pay for the purchase price of $267,000 plus all these charges. So let's start with the buyer. After the contract sales price, what are some of the more common closing fees that you would see debited to the buyer's account? Well, the buyer will probably have to come up with a title policy, a homeowner title policy. So the buyer's about to purchase this home, and the buyer will have to come up with about $750 to protect the buyer against claims that come forward later on after the buyer becomes an owner, but these claims were from before the buyer purchased the home and they didn't show up in the title search. So paying for the title search and paying for the title policy, that would be about $750, and that will increase the cost basis of the buyer's property. It's not a deduction. It'll increase the cost basis. This is so that if somebody comes along later on after the buyer becomes the owner and says, hey, you don't own that property, I do. I've owned it for years. That title insurance policy will protect the buyer. Now, if there's a mortgage that the buyer's going to get, if the buyer's going to get a loan on the property to help pay this $267,000, then the lender will want that same title policy, and that'll protect the mortgage company against those same claims that could potentially come forward from before the buyer purchased the property. So without these title policies, the mortgage company would potentially have the same risk as the buyer. Somebody could come along after the closing and say, hey, buyer, you don't own that property. I own it, and I've owned it for years. and that would impact not only the buyer, but also the buyer's mortgage company who loaned money so that the buyer could make the purchase. So both of these costs would increase the cost basis from $267,000 and be charged to the buyer on the closing statement. They might end up being a little less than this cost, they might end up being a little more, but there'll be both of these on a typical closing statement if there's a mortgage. If there's no mortgage and the buyer's paying cash for the property, $267,000 coming in with a check for the full amount from their savings or whatever, then all you would have is the $750 homeowner title policy to protect the buyer. You would need to protect the lender if there was no lender. What else might be in the buyer's debit column? How about a deed transfer tax? A tax imposed by the state simply for purchasing a property. Every state would have a different rate, but it's usually based on the sale price. So if it's a $267,000 purchase, then maybe half of 1% might be imposed on the buyer, and that would be $1,335 charge to the buyer at the closing. You might be wondering, what about the seller? Why wouldn't the seller pay this? Well, the seller might have a deed transfer tax also. The state might charge the seller and the buyer 0.5% each. Here's the way it would look on the buyer's side. What would it look like on the seller's side? There would be a debit in the seller's column for this $1,335 also, if there was a deed transfer tax that impacted the seller. So we know there's a closing statement for the buyer and there's a closing statement for the seller. We're going to try to just focus on the closing statement for the buyer right now. So far we have the contract sales price plus the title policy for the buyer plus the title policy for the lender, plus the deed transfer tax. All of this would be added to the cost basis of the buyer. And if this were the last charge, your initial depreciable basis would be the $267,000 plus $750 plus $850 plus $1,335. And if this was residential real estate, then the buyer would depreciate over 27.5 years. If this was a commercial property, 39 years. The next one is more of an if. If the purchase price was over $1 million, there might be an additional transfer tax. On top of the 0.5%, there might be a 1% additional transfer tax. They call this a mansion tax. And if the price was over $1 million, let's say it was exactly $1 million, $10,000 more in transfer taxes would be charged to the buyer. And on the CPA exam, you tend to deal with some heavy hitter clients, so there could be a mansion tax, so I just want you to be aware of that. That would be more, $10,000 more in the debit column for the buyer. All right, now we're going to look at prorated property taxes. This will always be on the closing statement because the buyer is responsible for real estate taxes from the day of closing forward. And this usually results in prorating based on the number of days that the buyer owned the property since the last time taxes were paid. So let's assume that the seller has already paid the property taxes for the entire year, and that was $6,000 for all of 2021. And let's assume that the closing took place on September 30th, 2021. That's when the buyer becomes the owner. Well, then the seller who paid all the property taxes for the entire year deserves to be reimbursed, credited for property taxes already paid for the period October 1st through December 31st, since the buyer is going to be the owner during that period. And the closing company will perform this allocation. They'll take the $6,000 annual property tax payment that the seller made, divide by 12, come up with $500 per month, and then multiply by the 3 months, October, November, and December, that the seller deserves to be reimbursed. So this $1,500 will be another charge to the buyer at the closing. Now on the CPA REG exam, they'll ask you, where does this $1,500 go? Does it go into the basis of the property for depreciation purposes? And you'd say, no, this is a property tax deduction. So if this were a rental property, this $1,500 would show up as a separate deduction for real estate taxes. And the exam would expect you to know where those items from the closing statement would go to impact Schedule E. You see where the taxes would go. The other items that would come from the closing statement that would likely impact Schedule E might include utilities, insurance, and those would be prorated just like the taxes were. Utilities, if paid by the seller in advance, the seller would receive a credit from the buyer at the closing. Let's take a look at the seller's closing statement now. First thing we notice is the contract sales price of $267,000 is on the credit side. It was on the debit side for the buyer, but it's a credit for the seller. Remember, what's on the credit side is good for you. As for the debit side, we find the commission paid to the real estate agent. Commission paid to the seller's agent and to the buyer's agent. Sometimes the buyer has their own real estate agent, and if so, that real estate agent will get compensated at the closing. But guess who pays the commission? The seller. The seller pays the seller's agent and the seller pays the buyer's agent from the proceeds at the closing. This commission is typically 3% to the seller's agent, 3% to the buyer's agent, and based on the sale price comes out to $16,020, and this amount will show up as a debit on the seller's closing statement and result in less money for the seller at the closing. When the seller goes to determine gain or loss on the CPA exam, what are you going to do with this $16,020?